Welcome, everyone. I am Jen Torgerson. I'm a sales counselor here at RiverWoods, Manchester. We're so glad you could join us today. We'll be covering a couple of housekeeping notes first. You are muted, but we welcome your questions. There is a Q&A box down at the bottom of your screen, so you can start entering your questions at any point. We'll try to get to as many as we can toward the end of the program. We do appreciate your suggestions and value your feedback, so feel free to reach out. And this presentation will be recorded. You will receive a link via email within a few days. So we're going to focus very briefly about CCRCs initially today that are an insurance product, not a purchase, not a real estate product, but an insurance product. Real quick, our contracts are regulated by the state of New Hampshire, the Department of Insurance annually. Also, our financials are reported to the state annually. Essentially, you are prepaying and insuring for future care needs, assisted living, memory support, nursing care, and a portion of the entrance fee and monthly service fees are tax deductible, as the contract is considered a prepaid medical expense. But really, it's a lifestyle choice. You enter when you're living independently, safe enough to live on your own. We do all the work. You leave the maintenance chores up to us, and you're able to enjoy all the great services and amenities that we offer, pre-scheduled transportation and dining and housekeeping, and so many concerts and lectures, activities, fitness classes, clubs, volunteer opportunities. So a lot going on. It increases your social activity as you age, and allows you to stay in control of your life in the future, knowing where you'll have future care, the quality of what that care will be, that will always have availability for you, and what it will cost. Allows you to stay in control of your life. So continuing care retirement communities, again, you enter when independent, safe enough to live on your own. You have to be 62 or older. They provide at least 3 levels of care, starting with independent living, of course, assisted living, nursing, and some have memory support. Residents can transition back and forth between the levels of care as their health needs dictate. Services and amenities provided at every level of care. And typically, again, an entrance fee up front and a monthly service fee, a portion of which are tax deductible. This allows you to meet new friends, have an active lifestyle as you age, increasing mobility and your social interactions, your nutrition, and your engagement, which leads to a healthier lifestyle. And we do have a benevolence clause in our contract, which means if you spend down your assets over time at no fault of your own, you can apply for benevolence annually, and we would subsidize your monthly fee. So you don't have to leave the community at a point where change is much harder as you age. So we have a saying, if you've seen one CCRC, you've seen one CCRC. It seems as though no two are exactly alike, but in general, there are 3 types. A type A, which is an all-inclusive insurance product with a higher level of entrance fee and monthly fee. You basically pay one fee all the way through at any level of care, plus a small annual increase. And you're covered for life. You can go back and forth between the levels of care freely, and you're prepaying for care essentially. About 82% of these type A communities are nonprofits or not-for-profits. And then a type B, RiverWoods, Manchester is a type B. It's a more targeted or defined insurance product where you're not paying for care until you need it. If you need it, we offer a lower entrance fee and a lower monthly fee. Access definitely to healthcare. 30 free days in independent living here at RiverWoods Manchester every year for independent residents. But at the point where you move to healthcare, you have a discount off the market rate. So you save a great deal of money on your healthcare over time. And about 82% of the industry are nonprofits or not-for-profits as well. Type C is more of a rental. You would pay market rate for healthcare at the point where you need it. They may or may not have an entrance fee up front or a large deposit, and the monthly fee covers meals and services. For all of these contract types, the larger the apartment, the more square footage, the more expensive they will be. And again, with the type C contract, some are nonprofits, some for profits, and you're paying market rate for healthcare. So that is the biggest factor there. About RiverWoods Manchester specifically, we have a long-standing history, almost 150 years actually, in the Manchester area, starting with the Women's Aid and Relief Society in Manchester. This building was built almost 30 years ago, and we've had several transitions over time from Pearl Manor, Hillcrest Terrace, Birch Hill Terrace. We became Manchester's only CCRC in 2009 as the only Type B offering in the RiverWoods group. And we joined the RiverWoods family in 2016 as Birch Hill, and officially changed our name in 2021. We've undergone about $16 million in renovations on the interior of independent living, the apartments, the hallways, all the common areas, put on a huge addition with activities and fitness 3 times the size of what we originally had, and an art gallery area. Then we're working in the healthcare side currently, doing complete renovations, and then we'll be working on the exterior of the building. We do not have a wait list because of this ongoing renovation process, and have several apartment sizes available. And basically we're located on a beautiful wooded 29-acre campus, just 10 minutes from downtown Manchester, about 20 minutes to Concord, with beautiful nature preserve across the street, about 600 acres, and public trails right down the road. We offer an innovative 70% flexible contract, entrance fee contract option. It's the only one in New England of its kind. You can use your 70% refundable entrance fee to pay for the increase in healthcare costs each month. So again, at the point where you're moving from independent to assisted living or a higher level of care, the difference in the monthly fee, well below market rate, but it can be drawn down on your 70% refund, allowing you to use that refund while you're alive. Typically, a refund is left to your estate, or you take it with you if you leave the community once someone else buys your apartment. So it's a flexible option. It's your choice. You can spend it down or you can leave it to your estate. It's a more affordable, lower entrance fee contract than we've ever offered before. A great value for couples. Allows predictability of cash flow over time, similar to a type A at a lower cost. Like long-term care insurance works really well here, reimburses you for any care that your contract offers in our community. And again, predictable, flexible, great value for a contract, and better discount on healthcare than we've ever offered. So today I would like to present our 3 wonderful guests, Mr. Keith Robertson, Managing Director at Ziegler, Mr. Kevin Goyette, CFO of the RiverWoods Group, and Mr. Dennis McMahon, who moved into RiverWoods Manchester several years back with his lovely wife, Donna. And Keith, I'm going to hand it over to you.
Great. Thank you so much, Jennifer. It's great to be here, and thank you for listening to what we have to say. So my job today is to give you a high-level overview, a macro sense of what's happening in the senior living and care industry. Just for a quick understanding of who Ziegler is. Ziegler is a boutique investment bank whose primary role is to raise capital for not-for-profit senior living organizations. I've been with Ziegler for about 15 years. And dedicate 100% of my time to working with not-for-profit senior living organizations like RiverWoods Manchester. As a firm, we even though our primary role is raising capital, we have invested a significant portion of the firm's resources in research. We have a woman who works for us who leads our research group. Her name is Lisa McCracken. Lisa and her team really spend all day, every day, trying to understand what's happening in the industry. They create several publications, but basically provide me with the information that I'm going to share today. They're a great resource for the firm and really for the industry. So I tell Lisa all the time that it's all the work that she does makes me and Ziegler look a lot smarter than we actually are. So the first slide that we normally talk to when we go through presentations like this is the most important macro trend that's happening in the industry is the demographic wave. We all know that the baby boomers are nearing retirement. Many already are retired. And those numbers are affecting what we all do in terms of looking towards the future. Looking back to 2015 through 2035, so about a 20-year period, the number of folks who are 75 and older is going to double. So it's a very significant increase. And then frankly, it's driving all the conversation in the industry. All the providers are looking at those numbers and trying to understand, one, what those consumers are currently want and what they will want, and how best to serve all the folks that are coming our way. Next slide, Kim. So one of the research studies that Ziegler did move forward with was actually a count of the CCRCs. If you notice on the title, we have the phrase LPC. After we had done our initial count of CCRCs, there was a desire to change the name away from continuing care retirement community to a life plan community. So as you're looking at CCRC options, you might also run into the word life plan communities. But Ziegler attempted to count all the life plan communities and or CCRCs in the country. Recognizing, as Jennifer said earlier, you've seen one CCRC, you've seen one CCRC. They aren't necessarily all uniform. So counting them was actually much harder than we had originally thought. But you'll see in some certain pockets of the country, CCRCs are very predominant. California, Florida, Pennsylvania, Ohio, Illinois, there are a lot of CCRCs. Other parts of the country, like the Northeast, they aren't as predominant, but really within each portion of the country, there are many retirement options. In New Hampshire, the count that we have here is 20. Although if you're looking at a RiverWoods Manchester, there probably aren't 20 communities in New Hampshire that look or feel like RiverWoods Manchester. But it met several facilities up to 20 met our definition. And as Jennifer mentioned earlier, roughly 80% of all life plan communities are not-for-profit. And that's predominantly the product type that the not-for-profit senior living organizations prefer. There are some unique characteristics about the CCRC that really benefit the not-for-profit model and allows them to really pursue that type of product line. Next slide, please. And there's one more flying, if you could bring those in, great. So as I talk about macro trends, the most important macro trend that the industry itself is dealing with right now are workforce pressures. I am sure that you've heard from listening to the news that there is a shortage of workers. That is directly affecting the senior living industry fairly dramatically. And it's something that we've been aware of for a long time. And managing workforce issues has been something that folks like RiverWoods Manchester have needed to do for years. But what used to be a workforce challenge is really become or has become a workforce crisis. We are not necessarily sure if there's an end in sight, but it's certainly something that we are watching very closely in terms of the ability of organizations like RiverWoods Manchester to grow and to provide new service lines. So it's certainly maybe the most important macro trend that the industry itself is dealing with. Next slide. So occupancy is the fuel that drives the retirement community engine. And during COVID, the past year and a half, occupancies across the sector, both the not-for-profit and for-profit sector, have been greatly challenged. This slide here demonstrates, going back to 2006, occupancies in the not-for-profit CCRCs were somewhere, I would say on average around at 94%. The financial crisis years drove occupancy down to somewhere around 90% on average. We started to kick up a little bit in the mid 2000 teens and stabilized right around 92.5%. But when COVID hit last March and folks weren't able to move new people in, occupancies declined very significantly from 92, 93% to on average around 86%. Recognize this is nationwide. The Northeast has, I would say, fared a little bit better than the national averages, but we have seen, I would say, at least a 6 percentage point drop in average occupancies across the sector in the not-for-profit communities that we research. On the for-profit side, that decline has been more substantial, close to 9 or 10 percentage points. And they were generally, or most for-profit entities were slightly below the not-for-profit average as well, primarily driven by product type that they offer. Most for-profits offer more of a rental model, not the entrance fee product. But in general, they've been hit much harder. What you will see, and very recently, our occupancies are either stabilizing or starting to tick up, especially on the independent living side of the industry. So we are starting to see that trend, which is comforting. It makes all of us feel good that we are at least out of the bottom, and are excited to see where occupancies do go. I think from what we're hearing across the industry, occupancies in independent living are doing well, but still on the healthcare side of the marketplace, occupancies are still challenged, especially on the assisted living side of the marketplace. Next slide. So Ziegler, as a part of the research that we do, we poll our, frankly, not even our client base, but the entire sector on an ongoing basis. And one of the questions that we frequently ask is about growth. And we had polled folks right before COVID hit. We polled them again during the summer of last year to see how COVID had affected them. And then coming out of COVID this year, we polled those same organizations. And you can see that there is a slowdown of growth really caused by COVID. And those numbers have stayed relatively stable throughout COVID. The one area of the industry where growth has accelerated through COVID is the growth or the expansion of HCBS platforms. So HCBS stands for Home and Community-Based Services. So that's, it's not bricks and sticks. We're not putting up any kind of buildings, so therefore not borrowing any money. But organizations that were programmed to grow or thinking about growth before COVID and now coming out of COVID have turned their attention more to growth in looking at serving people in their homes, not necessarily in communities, which is a fairly significant change within the sector. On the bottom half of this slide, we also broke down the data between multi-site organizations like the RiverWoods group that have multiple facilities and single sites. And it's fairly significant. The amount of growth that we're seeing is really coming from the multi-site organizations. It somewhat makes sense if you look at this data. These are organizations that have already grown. They've gone from 1 to 2, 2 to 3, 3 to 4 facilities within their overall family. So they're already pre-programmed to grow and understand growth. But that's where we expect future growth within the industry to come from. It's from those multi-site organizations. Next slide. So a macro trend that we are following and frankly have been following for the better part of a decade is the consolidation that's occurring within the not-for-profit senior living sector. Since 2015, 602 standalone facilities have changed hands. A lot of those facilities, more than half, have actually ended up going from a not-for-profit entity to a for-profit entity. So as the not-for-profit sector has been consolidating and frankly shrinking, the for-profit sector has been growing significantly, not just by building new buildings, but also in acquiring or gobbling up some of the smaller not-for-profit organizations that have decided to, it was too hard to go it alone. This trend is frankly, I think, a favorable trend for the industry. There is strength in numbers. There's efficiency that can be found with scale. And as the sector consolidates, organizations like the RiverWoods group, who perform very well, have a lot of resources, not just financial, but in terms of staffing, they're able to really provide a lot of value to organizations that may have been a single site. And I think RiverWoods Manchester is that perfect example of a small single site that would not necessarily be able to thrive on its own. When it becomes a part of a larger, stronger organization, it really can thrive. Next slide. So one of the macro trends that we have seen over the past year and a half is the acceleration of organizational acceptance and utilization of technology. Technology has been a part of our industry, I would say, forever, but it's accelerated over the past decade. But the amount of acceleration that we saw over the past decade was doubled over the past year and a half. Organizations, just the fact that we're doing this presentation, we used to do this presentation live. The fact that we're doing this presentation right now over Zoom is a sign or an indication of how great the acceptance is of technology. I would say the biggest acceleration is in telehealth, has certainly accelerated. And as we're dealing with the workforce challenges, workforce solutions have also accelerated fairly significantly. The one thing that I think is so unique is how rapidly folks from young to old really accepted the use of technology. It's allowed us to stay in touch when we couldn't necessarily see each other. So I think that's something that we're going to be very aware of going forward is how much and how well organizations utilize technology. It goes back to that there's benefit of scale. A large organization like the RiverWoods Group has the capacity and the ability to utilize, understand, implement all the technologies that are out there. A smaller single site organization that really is standing on its own, they don't have the personnel resources to really understand the technologies that are out there, purchase them, implement them, and then keep up with all the changes. So it's part of the benefit of being a part of a larger system. So we do expect technology utilization to increase significantly over the next decade. So with that, I think I'm going to turn it over to my friend, Kevin Goyette, who is the Chief Financial Officer of the RiverWoods Group. Kevin? On mute.
Thanks a lot, Keith. Appreciate the high-level overview. And for the audience out there, you'll notice that we are covering a lot of information in a short period of time. So please note that this is a high-level overview, but the recording will be available to you, as Jen mentioned earlier, and also we'll make the slides available as well, so that if you feel you missed something in our verbal conversation, you have the ability to go back and look at it on paper as well. We just wanted to get as much out there for you as possible. So I'm gonna take you through a more 5,000 foot view as opposed to the 30,000 industry foot view that Keith just provided. Just a quick snapshot of our family of communities here, with RiverWoods Group supporting them as the parent, but really being a supporting organization in the not-for-profit world. 3 campuses in Exeter, 1 in Manchester, 1 in Durham. And what we always show in a chart such as this is someplace else or something else. So if we have the ability to further the mission moving forward, we want to be able to do that. And there are plenty of opportunities, as Keith has outlined earlier. Our organization is grassroots. We have no affiliations with universities, fraternal organizations, or religious organizations. We are a community that has grown from the start and have used what I call bite-sized growth. We have done enough to keep out competition, but not over leverage ourselves such that we have fill up risks when starting a new community or operating a stabilized community. And we really operate under those 3 mantras there: are protect the core. So what we've built, we don't want to put at risk. We want to maximize efficiencies across the system. And then we, again, want to serve that mission going forward if we have the ability to look into the future as the demographics and the market does change over time. One interesting thing here is, from a RiverWoods perspective, we have an incredible volunteer board that provides a lot of information for us, and we have a very qualified management team. Part of the ability of being part of a system, as Keith mentioned, is you can go out and have individuals with unique unique skill sets that you're able to leverage across the system. And we have very long tenured employees on our senior leadership team, and we also have newer members who are bringing a fresh perspective as well. So enough about us, and it's really about you today, but as you're thinking about the next stage of your life and what choices do you have, what I would say first and foremost is plan. Be thinking about it, be diligent, and don't hide behind the being scared of making a decision, because there are a lot of things that will come up, but having a plan in place and putting assumptions in place about what you want your future to look like, you have the ability to look at all different scenarios. Here are some ideas of what could change, some major assumptions as you go through the process. It's not much different than what we do as an organization. We are planning for our future. We are always making major assumptions, retesting those, running scenarios analysis. We want to understand our options. We recommend that you understand all the options available to you, and we're going to touch upon some of those this afternoon. 5 options that are available to you in no particular order, and some are a little more interesting than others. But you could right now say that I'm going to stay in my home. I've been here 30 or 40 or 50 years. I'm never going to need any additional services. I'll always be able to live independently. That's an option. That's a choice for you. You could stay home and assume that at some point you will need higher level of services, but you can plan now for the ability to bring those services into your home. What I would say on that one is, in this day and age with the healthcare labor shortage, especially on the healthcare side, the ability to find those services may be a little more of a challenge for individuals. The one that usually gets a laugh in the live presentations is choosing to cohabitate, living with your kids or having your kids come live with you if you need help. Now, that is not a very popular option from what we've seen over time. And then you could not make a choice now and then have a need-based decision to make later on, where you have a need for higher level of care. And with that decision, that no longer becomes what you want, it becomes what you need, and your choices are much more limited. And so, as Jen mentioned earlier, the ability to look at a life plan or community or a CCRC, you choose, you change. You have the ability to make your choice now where you want to spend the rest of your life, and having the ability to move to different levels of care if you need them. By opting into a CCRC, you know where you're going to be for the rest of your life. And that's where we'll concentrate today. CCRCs, as Jen mentioned, Manchester has been around for over 100 years. CCRCs have been around for well over 100 years with their roots in the Pennsylvania Quaker area. Typically not for profit. They have a benevolence clause. Typically, 2 people can live cheaper than one. In a CCRC, you don't have double the cost if you come in as a couple. And again, you make your choice. You have the choice to make the decision. While you're able to make it, you can make that for your future. Some thoughts as you look through different CCRCs, and I won't go through every last one here, but here's some ideas for you to think about as you're investigating different communities. And this is a financial presentation at the end of the day, so it should be no surprise that most of these items are financially based. But what I'd point you to is really the last bullet on this slide. And do you have the ability to speak with the financial executive at the community as you're going through your investigation process? It's one thing to talk to a sales counselor. It's another thing to have another perspective, a different lens of the individual who is responsible for the finances of the community. And what I would say there is, one, it's a red flag if the community says no, personally, but if they say yes, it's a green light for you to dig into it deeper. They really have nothing to hide. And really, as you meet with the individual, understand the business model. I'll show you Manchester in a second from our perspective. But listen in, and can the individual explain it to you in non-financial terms that lay people can understand? And does it make sense how they look at the business? Out there in the marketplace, you'll hear, well, I have Medicare coverage or I have long-term care insurance, I should be all set. I won't go through the details again of this slide, but Medicare is very limited on what it covers. And similarly, long-term care insurance, if you do have that benefit, it doesn't tell you where you receive that benefit. So you can marry a long-term care insurance policy very nicely with a CCRC and make your choice and have the best of both worlds. Jen talked earlier about the different contract types. A type B, from our perspective, we like it. It's kind of the best of both worlds. You're really paying for more of the care. If you need more care, you're paying for that. But if you don't need more care, you're paying less. And you have the ability, as you look forward, to still have access to that assisted living, memory support, or nursing care should you need it at a later period of time. The business model for RiverWoods Manchester is really quite simple. And I would say most CCRCs probably work somewhere along these lines, but each one will have its nuances. But working left to right, there's the one-time payment, the entrance fee that you make to come into the community. The organization will take that. And by the way, green, I'm an accountant at the end of the day. So green is good, green is money coming in, red is money going out. The organization will take that entrance fee cash. They'll put it in its cash and investments. For RiverWoods Manchester specifically, we will utilize that to generate investment earnings and also build reserves for those scenarios that may come up, such as a pandemic. It really allows you peace of mind to be able to continue to operate in a sound financial manner. And then that cash and investments we utilize portions of it to invest in our infrastructure, so capital investments, large ticket purchases to keep the campus safe and desirable. And also, just like your home, we have a mortgage at RiverWoods Manchester, so we utilize some of that cash to pay our mortgage on an annual basis to the bank lender. The second column there, the ongoing monthly service fees, our expectations is that cash coming in will be available to cover our cash operating expenses on an annual basis. And then lastly, we have an entrance fee refund for the majority of our contracts. So we want to make sure that we meet that contractual obligation when the time comes. So again, we're using our balance sheet reserves to be able to ensure that we meet all of our promises while you're at RiverWoods Manchester, but also once you leave RiverWoods Manchester and your refund is owed. As you're going through your journey, things to think about, this doesn't even cover startup communities. Startup communities have startup risk, construction overlays. It kind of goes without saying, but those are red flags. But even with mature communities, you want to be looking at their occupancy. That is the lifeblood of any continuing care retirement community. There is a flow of residents throughout the continuum of care, but an organization that has a strong wait list and is able to reoccupy its independent apartments as they turn over is one that is stronger, and you want to look at a long history of strong occupancy results for the community. Look at the communities on the balance sheet side. Do they have too much debt? If they're over leveraged, that could be an issue down the line. Evaluate their competition in the area, and then also look at their grounds, look at their building, their inside amenities. If it's aging, that sometimes says that they either don't have a purposeful reinvestment plan, or they may have too little debt, that they may have forsaken capital reinvestment in the community in order to pay down debt. That's an issue as well to be able to pay attention to. The strong communities out there, you'll be able to see that. You'll be able to hear it from their leadership teams. Smart, reasonable growth, bite-sized growth, as we like to describe it here. Access to the capital markets, and be able to not only issue debt, but also to be able to continue their capital reinvestment plans. And looking at their financials. And as Keith mentioned earlier, the organization and the industry is really moving towards consolidation to, one, deal with the shortage of the labor market out there, but also to leverage efficiencies and leverage the strength of strong senior leaders across the system of communities. Some resources that we make available to you all: the Insider's Guide Choosing a CCRC. This is available from our team. Also on our website, on the next slide, Kim, we have our audited financials for our system posted, our annual reports, as well as a few white papers that I have written over the years to help somebody looking into the life plan community avenue. And there's two out there. There's one that is for a potential future resident, and there's also a more technical white paper for the financial advisors or legal advisors of prospective residents that has more technical jargon in there. So they're both available on our website as well. If you have problems finding them, talk to Jen or Kim, and they'd be more than happy to provide that detail to you as well. As Keith mentioned earlier, it's all about occupancy. An organization that is fully occupied or is on its way to fully occupied is all else being equal, going to be a stronger organization. This business model, once you build a large community, the majority of the costs are fixed. So the more paying residents you have, the less per resident each one is paying. It's all about reinvesting in the community. And a lot of that, you don't even have to look at the balance sheet. You can just drive or look at the website of the community, take a look inside and out. You will be able to tell pretty quickly if they are keeping up and making sure that it's a crisp contemporary campus. Jen mentioned earlier that Manchester has put $16 million in since the affiliation with the RiverWoods group 5 years ago. It's actually about $18 million now. And we anticipate close to $18 million of continued reinvestment over the next 5 years. And then as you're looking at the organization, it's very hard to compare communities. They're all different sizes and shapes. But most of the organizations that are measuring their performance will make available to you the ratios that they use to measure their performance against other industry metrics. You just have to ask for it. Kim, if you go to the next slide, there is a document out in the marketplace, and this one is not free. We can't reproduce this. This is copyrighted, but we have access to it, and it's accredited organizations participating on this. There are about 30 ratios that we are able to go in there and actually do the calculations and compare ourselves to like communities to see how we're doing, set benchmarks as we move forward. This is just a little graphical indication of what those ratios might look like, but organizations, as you go through, will be able to share these with you and walk you through how they look at the business. So I know that was a lot of information in a short period of time. Now we're going to take it down to the 100-foot level. We're going to ask Dennis McMahon, who's a resident of Manchester with his wife. He has spent some time as a resident trustee at the organization as well. He's going to just talk about some of his oversights and observations for a life plan community. Dennis?
Probably should unmute, huh? Works better. My wife and I moved in here 4 years ago. Middle of next month will be 4 years. We had the unpleasant task of working with my mother through this whole process, looking at places, going to places. We learned how to do that. And when we came here, it was pretty obvious that we had a match. The flexibility in living here is like living in a hotel. We have excellent people in the wait staff and in the staff in the building. And it is easy to live here. Now, we won't count COVID time. But even with that, we're amazed at the amount of help we got through that whole process. They certainly showed they're flexible and willing to do it. I am, and my wife is, post-war baby boomers in the first wave. So we're used to running into things and running into 27 people right beside us going the same place. Although the good news here is we didn't run into that. In fact, my two daughters pushed back and they said, "You're too young to do that." And I said, "Well, you're welcome to your thought." But shortly after we moved in here, my wife fell and damaged her spine. And it's been great, the care she got and how we still fit in. If we hadn't made that decision some time ago, I'm sure it would have been a lot harder. Don't know really where to take it from here. We're very comfortable here. We like it here. I like the support staff. Most of them like me. I'll get over that.
I like you, Dennis.
This is. There's a sense of comfort and relief. I mean, we lived in a house in Hollis, and for 20 years. We had it built and we loved it, and people just couldn't understand why we wanted to leave that. And I said, just in case. And just in case is just exactly what we needed. We're quite comfortable, even with COVID, because we've learned how to, and our staff has learned how to take care of us. One of the things that I saw in the financial section is the option to, various options to go. You can sign up for this and they'll support you with the rest of the life. I found one of the best answers I could. I saved a lot of money. A few $1 million will go a long way. I like that because I control it. The people are always questioning, how can you afford that? Well, we can't afford not to do this. It would be a lot more money to do it anywhere else. So it wasn't a money question. It was, are we going to be happy there? Are we going to get along with the rest of the residents, the staff? And no question, it's all there.
Thank you, Dennis.
Yeah.
Dennis was kind of ahead of his time because he started a trend that we're seeing now, which is people moving in younger than ever before. And a lot of people are surprised seeing people move in their 60s and early 70s, but it really is happening. So we're going to get to a Q&A here. Anyone who does have questions, please enter them into the Q&A box. Our first question from Ruth is, what is a benevolence clause? Kevin, do you want to take that one?
I'll take that one, Jen, so thank you. So once you are accepted into our community, as long you have a place to stay for the rest of your life, even if you outlive your assets. And there's really only two caveats to that. One is on you. You can't gift your assets away after getting accepted into the community. So you can't personally impoverish yourself. But if you outlive your assets, you have the ability to stay at RiverWoods. We will provide financial assistance to you. And that financial assistance will be provided to you with the second caveat only being, we can't provide financial assistance to one person if it would have a financial impact on the community at large. So that is language you'll see in the contract. But I have, with our 3 communities within the RiverWoods group system, we have never had that issue. We have had individuals who have certainly outlived their assets and have applied and received financial assistance from the community to continue to live within the specific community. It's a wonderful thing. It's peace of mind for you all. And it's peace of mind for your heirs or your sons and daughters to know that they don't have to figure out a way to come up with the shortfall.
Kevin, can you speak to the refund and how that works?
Sure. So one time you make a one-time entrance fee to join the community. And depending on your contract type, we have various options here. But we do have one option that is a 70% refundable contract. If you are a single person, and let's say the entrance fee is $200,000, I'm just going to put a hypothetical number out there. At the end of your contract, when you have left RiverWoods Manchester and your independent living unit has been resold, the community has 60 days to refund to your estate or to your designee 70% of the entrance fee that you originally paid, or in this my example, $140,000. But it's contingent on the later of your independent apartment being resold and you leaving the community. A couple coming in, the entrance fee that's related to a second person, which is somewhere around $27,000, that is 100% non-refundable. So the refundability is specifically around the first person entrance fee.
And if you go on benevolence?
So if you join the community in that example and you're a single person, you've outlived your assets, you have no more assets under your umbrella, you would apply for benevolence similarly, and the board of trustees would vote on it. And what it would be is the first stage of benevolence would actually be a 0 interest promissory note against that future refund. So we would actually allow you to continue to remain in the community. And let's say the organization provided you with $40,000 of benevolence. When the refund was processed at the end of the day, it would be a $140,000 refund less $40,000 that was provided in benevolence, which would go back into the benevolent fund. Your estate would get the net amount. Now, let's just take that a little further, and let's say that in that same instance, you lived a long life at Birch Hill, and you received $180,000 worth of benevolence. Your refund is 140. We would never come back for the additional $40,000. That is a true expense of the community.
And part of the charitable mission.
Absolutely. This is one of the benefits of a 501c3 not-for-profit charitable organization.
Mm-hmm. And one of the questions from Sheila in Texas. Hi, Sheila. Does benevolence apply to issues other than outliving your ability to pay, for example, unexpected significant time in nursing care?
It is specific to your ability to meet your ongoing monthly service fee obligations at the community. The reasons of how you got in that position would be considered as part of the application. So again, if you have no assets left under your umbrella to meet your Manchester obligations, but you've gifted all that money to your son or daughter, that would cause an issue. But we have had instances where people outlive their assets. We have had instances where a resident was scammed and lost a portion of their assets. So, but the benevolence is specific to helping you maintain your monthly service fee obligations. It is not to help your ongoing outside discretionary expenses.
If a refund is due for any variety of reasons, are there contingencies on that other than benevolence or fees due, right?
Yeah, it's outlined in the specific contract, but really it is it's 2 conditions that have to be met. Again, you have to have left the community, which typically means you pass away, although we do have some residents who choose to move out of the community. That's condition number 1. And condition number 2 is we have had to resell your independent apartment and take a new entrance fee for that. And then I believe the contract is the refund is due 60 days from when both of those conditions have been met.
Thank you.
You're welcome.
What happens if your unit cannot be sold?
It is in all parties' best interest that we resell all of the apartments. Again, it's all about occupancy at the end of the day. I will say this: we have never had an instance where an apartment has never been able to be resold. Sometimes it does. Certain ones take longer than others, but those typically we are pre-warriors within the RiverWoods group system, so we are actually tracking how long apartments are on the market open and unsold. And as if it's getting to be a significant number of months, then the finance team and the senior leadership team is actually circling back with Jen and her colleagues and the sales team to say, hey, what are you hearing about this? And sometimes we will need to be creative in order to overcome someone's initial not wanting a unit. So we spend a lot of time making sure all of our units have a healthy turnover.
Thank you. Ruth is asking, how does Social Security figure into benevolence? Also pensions if they do not cover fees. And down below, she asks about discretionary spending. There's a set amount that you assume for discretionary spending when someone applies. Can you explain that to us, please?
Yeah, Ruth, really good questions on that. So we actually will factor into, for somebody before they join the community, we will request a financial data profile, and we will run it through our actuarial software. We have underwriting criteria to make the assumption of whether somebody is accepted financially into our community for a specific unit. That does factor in the pension income, the Social Security income, the income from investments and other rental income or what have you, as well as making some assumptions on discretionary expenses outside of the community. If somebody has made a request for benevolence, we will request financial information from that individual, pretty much looking through it, doing a sanity check of what has changed from when that individual came in the community to now. We owe that not only to the individual requesting benevolence, but also to the greater community at large to make sure that we have really followed our process and that we are protecting everyone in the community. But we will basically look at the income sources coming in and the expenses going out, and we will make a recommendation to the board for the right amount of financial assistance for that individual.
Mel and Rachel are asking, can we explain the process of sometimes needing to go from one level of care to another and back again, costs and timeframes? I can speak a little bit to that point. Everyone in independent living qualifies for 30 free days every year for a short-term respite stay. So we have 2 rooms set aside in the manor for assisted living or nursing care for a short-term medical need. For example, if you had a knee replacement or a shoulder surgery or something like that, you would fill out the paperwork as if it was an assisted living admission and have 30 free days or up to 30 free days. And you can break it down throughout the year. So if you went and used 2 weeks of a free stay in a respite room and came back to your apartment, something else happened, maybe you had pneumonia, you could go back and have another 2 weeks during that year. It doesn't carry over, but it's pretty flexible, and it's really been a gift to the residents here in independent living. At the point where you move permanently to assisted living, if you do, you get $1,000 off per month, and that's off the market rate for assisted living fees for your lifetime. If it's a couple, then each of you gets that discount. For memory support, you receive $1,500 off the market rate per month each. And for nursing care, it's $2,000 off the market rate per person. So great long-term healthcare savings, short-term 30 free respite stays. Some people do stay longer and pay by the month or a daily respite rate. But it is a gift, and it also helps people to become familiar with the community early on in the process. Some people, you know, as they age, living longer than ever before. So more surgeries, more little health issues coming and going. And some people do that circuit numerous times over the years. You get to know the staff, they get to know you, it all becomes comfortable, and the entire community becomes your home. So great cost savings, free respite in independent living, and just a gift with care coordination from the coordination team or the care team here for the rest of your life. Let's see here. Looking down the list, which units sell most easily? Kevin, do you want to take that one? You probably know better than I do.
Well, I'll start it with it depends, but I would say one of the trends we are seeing, and not just at Manchester, but at its sister communities as well. The larger units typically are seen as more desirable by the marketplace. But that doesn't mean that the smaller units are sitting around on the sidelines as well, because everybody has a different philosophy on what type of unit they want. And from my perspective, you know, there's so much common space at these communities that don't necessarily need the largest unit, because you're not going to be spending all that much time in your individual unit if you're out and enjoying all the amenities of the community. So it really depends, but you know, sometimes the more difficult ones are the ones that sit smack dab in the middle. So a 1-bedroom with den floor plan, sometimes that's not the one that is the most desirable for the marketplace. But again, we work through all of those, and there's Keith's demographic slide from earlier shows that there are millions and millions of baby boomers out there. So there's a lot of different opinions, and we believe that each of the units will be desirable to some snippet of that market.
Thank you. Susan Chamberlain has a question. Hi, Susan. If a couple is in independent living, one of them needs, for example, memory care, how would that affect the monthly fees for that couple? The same independent monthly fee plus memory care fees. So if one spouse went to memory support wing, the person in independent living would pay the first person monthly fee in independent, and the other person would pay the monthly fee in memory support. I don't know if you want to add to that, Kevin, or.
Yeah, I would just say that. So that outline in that instance, that is that reflects the type B contract, whereas in a type A contract, that individual who would move into memory support would actually still be paying the second person monthly service fee from independent living. So it's, as you look at all these different contract types, it's kind of looking at all the scenarios that may come up.
Right.
But and that memory support at RiverWoods Manchester with the type B would be memory support price, market rate, less the contractual discount afforded by the life care contract.
Mm-hmm.
So it wouldn't be full market rate. It would still be a discount to the regular market.
I had a question recently, maybe you can answer, is how do you determine market rate?
Well, I don't, if you're looking in the back, that's a coat hanging up on a mirror, not a dartboard. We actually will work with outside consultants. We have I'll call it the mystery shopper type of approach as well, to be able to go out and understand what other rates are out there. We've actually just done that recently across the system to make sure that we are competitive and you know, we're not overpriced, we're not underpriced, but we're in the range of the market around us. And it really is engaging. Sometimes it's engaged paying for that data information, and sometimes we're able to discern it outside of that. And then it is not just about price, but it's also about the services that are provided. And sometimes you will see that with a CCRC where they may appear that they have a higher base rate than a for-profit standalone assisted living unit, for example. But the standalone for-profit assisted living organization will probably have multiple pricing levels, and they will very quickly ramp you up to the higher levels of care and the higher pricing points, whereas it's not the same type of business model with a not-for-profit. There are no external shareholders in a not-for-profit. So be careful about that.
And it's wise to ask for a copy of the contract and read the details.
Yes.
Well, thank you all. I know we have one more question, Mr. Sparrow. I will get back to you in regard to the specifics of that one in apartment sizes and costs. And I just want to thank all of our speakers. We're out of time now, but thank you, Keith, for all your great input. Kevin, Dennis, we're so appreciative of all of you being here today. And we welcome more questions from anyone out there. Give us a call Carmen, call me, and if we can't get the answers, we will get them for you. So thank you again, everyone, for joining us. And
Thank you, Jen. Thanks, everyone.
Have a good day.
Thank you. Bye-bye.
Bye.